Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Hi there. Welcome to another fun-filled almost hour of conversation about money. Actually, it's a fun-filled 36 minutes or so when you take out news, traffic, and commercials, because every Monday I clip these things down and turn them into a podcast with only like 10-second commercials. So.
And yeah, but if you think about my situation, I checked. I had 8 seconds in the second hour of last week's show. So there you go. I think I just filled it all up.
Wait a minute. Wait. I let 8 seconds of you in?
You better find out who's editing these things and get on it, dude.
No, I got to go back. I got to make sure it's all done all the time. Let's just go all done all the time, shall we? Hi, welcome to Talking Real Money. I'm all Don all the time. That's all Tom some of the time. And our phone number is 855-935-TALK. If you would like to call us and talk about stuff.
Glen Court 50862 was our number. GL5. Oh, okay. All right.
Last hour, so old news. That's so last hour.
Think how happy you're going to be in an hour from now. You'll be rid of me till
last hour, Tom.
Monday morning.
Yeah, hey, there's something really interesting. Like a few months ago, and I know we talk about this occasionally, but really, it's still it continues to be so stupid. We have to talk about it again. Just a few months ago, cryptocurrencies were worth in total, the total value of all the cryptos out there, were about the equivalent of the total value of the British stock market in aggregate, the entire country of Great Britain.
I thought they added up to Elon Musk's lunch bill, but okay.
No. They were about $3 trillion. $3
trillion. Okay.
Yeah. Now they're at about $1.6 trillion.
Oops. Elevator down.
Oops. But yet, still, people love
Hope
them.
Springs eternal.
Every day I read all these major publications and minor publications, and every day I read something somewhere about crypto. Something somewhere about crypto.
Can't avoid it.
Now crypto, 1.6 trillion. That is about the GDP of Canada. The gross domestic product of Canada.
I am not going to say anything bad about Canada.
Because you're too close. They could just lob.
They'll be right here in about 30 seconds.
They could lob a can of Molson's right over the border at you.
Well, that might be helpful. I'll take it.
Yeah, okay. No, Moosehead. Go for Moosehead.
Would be better. All right.
Anyway, there was an article. This was from the New York Times, and I believe it was today. It's about crypto, and it's about Matt Damon. Matt Damon, who is doing those commercials. First time I saw that, I went,
favor the bold.
Doesn't he have enough money? Matt.
Is he getting paid in Bitcoin, by the way?
Oh, probably, which means he's getting 50% less. Here's just a little snippet of what he said. Hold on.
These men and women, these mere mortals, just like you and me, as they peer over the edge, they calm their minds
into the abyss
and steel their nerves with 4 simple words that have been whispered by the intrepid since the time of the Romans. Fortune favors the brave.
I was going to say, now I am screwed. Okay, sorry.
Wait. On that
What did Matt Damon say on that Bitcoin commercial? Fortune favors the brave. My dad said he listened to Matt Damon and lost all his money. Yes, everyone did, but they were brave in doing so.
That was from South Park.
Brave in doing so.
They were brave in doing so.
Okay. All right. We do not use, nor do we recommend for our clients or our listeners investing in crypto. I'm not even going to call it a currency. Does a currency lose half of its value in the few weeks? Well, okay, we talked about this already. Weimar Republic or something other than that, or maybe some period of time in Argentina. But other than that, no, that's not a currency. Number two, you shouldn't be betting on currencies anyway. I mean, yeah, you can go bet on the U.S. dollar. You can bet on the yen. But no, I wouldn't invest that way.
But the thing is that the implication and the implication of this article is that celebrities are using their celebrity to enrich themselves on the back of a bunch of dummies, which are mainly young people who are eventually going to listen to this article, this quote from this article. Okay. Cryptocurrencies, after all, are in many cases not so much to what you said, not so much currencies as speculative thingamabobs.
Which you can invest in those, sure.
Digital tokens whose value is predicted largely on the idea, please listen to this carefully, whose value is predicted largely on the idea that someone will take them off your hands at a higher price than it cost you to acquire them.
And let's add a couple of more things. The Securities and Exchange Commission, they haven't figured out how you can they still haven't not authorized a mutual fund or an exchange traded fund where you can invest directly into crypto. You can invest into futures. And I'm going to steal this from Jason Zweig, who wrote today, gambling is for fun, but investing is for keeps. That makes diversification indispensable, which you cannot, I mean, unless you go buy a little bit of each one of these.
But that's
silly.
Okay, so okay. I go out and I make 17 snowballs over different times of the year. So they're different crops of snowballs. And I sell those snowballs to you, and you want to sell those snowballs to somebody else. Well, as long as you can keep that snowball frozen and you can keep that, maybe you might sell these diversified snowballs. But if you let them get below 32 degrees or above 32 degrees, you are going to have water. There's nothing there. There's no value. There's no value. A writer for Slate said that this business of celebrity selling crypto, called it a moral disaster. I mean, Kim Kardashian pushed something that went down 98% after she pushed the crypto. 98%.
Other than her show? Okay.
Oh, don't listen to these people.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And to this day, I'm still waiting. We're waiting. Tom and I are waiting. Our listeners are waiting for somebody to call us and tell us not what good is blockchain. Don't tell me that. I don't want to hear you're not up with the times. You don't understand blockchain. I do understand blockchain. Tom doesn't. I do.
Well, I'm blockhead. I wouldn't understand, so I get that.
But what good are cryptocurrencies? That's what I need explained to me, because I just don't get it. I was talking to a couple of friends, one a former U.S. Congresswoman, last night, and we were talking about crypto, and I said, what other monetary tool costs you 8% to buy it and then 8% to convert it back again? So I said, if you want to go buy some Bitcoin, you got to pay 8% to get the Bitcoin. And then, I want to turn that Bitcoin back into dollars so I can actually buy something, another 8%.
Dirty gold from Peru, I think, is the only other thing. So,
and before we go to the phones, I also want to mention something. I just happened to see this today on the Wall Street Journal's app or on their website. I love Joanna Stern. Not in that way, but I love Joanna Stern. She's the personal tech editor.
You're supposed to send me this article.
The Wall Street Journal. I thought I did. Yeah, I sent it.
Nope.
I did.
You didn't.
I'll send it again.
Nope.
I'll send it again because I have it right on my
screen.
screen.
You sent me Jason's article, which I
said her video's at the bottom of it.
Oh, I got to read your instructions. Okay, I'll try that next time.
I'll just send you the video because
I can just go online to myself.
You type in Joanna Stern, Wall Street Journal, NFTs, and that's what I want to talk about. I want to talk about crypto's evil stepchild. Non-fungible
I
tokens.
can't go there. I can't go there on this one.
Why?
I have a family,
So what?
My family's enriching themselves from NFTs.
Well, they're the evil stepchild of crypto because of the dumbest. They're the second dumbest thing. No, I actually think
nephews.
I think they exceed crypto in dumbness, but that's just me. Anyway, Joanne, it's kind of hard to understand because you hear about it and you go non-fungible token. And then I'm
surprised the number of people I run into that never have heard of them at all.
How do you get a non-fungible? How do you make something a non-fungible token?
I got mine in the shower, and it took me penicillin to get rid of it, I believe.
No, that's never mind. You have to mint it. And to mint it, you have to pay a gas fee.
Yes, that's true. By the way.
And Joanna Stern explains things beautifully. This is the best explanation of NFTs I have ever heard.
I could just upload it to the web or some social media platform. But nobody knows that this is the real original thing, that it's not just some digital copy. There's no digital info that says this is the masterpiece unicorn rainbow NFT made by my son. That's what minting it into an NFT does.
Minting into an NFT. You have to buy cryptocurrency to mint it into an NFT. It cost her $140 to turn her son's artwork that she digitized into an NFT. And then you have to put it up on an exchange. And guess what? There are more gas fees.
Well, no program has more gas than this one, so I get it still.
So if you want to watch if you really would like to understand it, you're going, I have no idea what an NFT is. Just go to Google or whatever your search engine is and type in Joanna, Joanna Stern, Wall Street Journal NFTs. And it is a 7-minute video that is very, very much worth your while. Just don't watch it during the next hour.
Can we go back to like regular stuff now? Resume normal programming, I think is what they used to say in the old days.
Yeah, I just wanted to mention that. Now we can go back to regular programming. 855-935-TALK. That's our phone number. And call us if you want to argue crypto. I'd love to argue crypto. I would. It would be fun. Chuck, you're next. Welcome to Talking Real Money.
Yes, I want to change the subject if I can.
You may.
Please.
Tom would be so happy because his head spins when we talk Nifties.
Okay, I have VGRLX, the Vanguard Global XUS, and I have it in an IRA, but I pay a 0.25% to buy or sell any shares, and I'm just wondering if I wouldn't be better off with the VNQI, which is the ETF of the same, has the same expense ratio. And I guess the final question is, would I have to pay the 0.25 to convert, or do you know that?
Oh, no, you shouldn't. Wait a minute. Where are the securities held?
They're both in a traditional
Vanguard
IRA.
Fund. Oh.
No, but
yeah.
I mean, they are in a traditional IRA, and
but
the
with
Admiral,
whom?
And
but are they held by Vanguard?
Yes.
Vanguard charges a fee to buy their funds?
That's the first I've heard of that.
To buy or sell the global XUS, you pay a 0.25%.
That's the first I've ever heard
of
this.
Yeah, been talking about Vanguard for
that is wacky, wacky. I've never heard that. But
I'm looking at it right now, and I don't see that on here. But okay. And by the way, this is a REIT, just to tell
maybe
people
it's
what
a transaction. No, this is the global XUS real estate, right?
Yep.
Right. VGRLX.
My understanding is that Vanguard is doing conversions between their funds to their ETFs at no cost and with no tax liability. It is a direct swap. They're actually just swapping the assets, so it's a non-taxable event.
Okay, well, this is in a IRA.
Right,
so
but I'm just saying for other people. But I would guess that if they're doing it for free for everybody else, I don't know why they wouldn't do it for free internally.
Okay, it does. I'm looking now at their website. It does. The front end does not have a charge. The back end does call it a load of 0.25. So, wow, that's the first I've heard of. Maybe it has to do with the way this particular REIT fund is operated in some regard. I don't know. That's unusual, but it shows no front end load. In other words, no commission at the front end, but that you have to pay 25 basis points on the back end. That's the first I've heard of any Vanguard fund. Very, very unusual.
Wow. I don't really know why it's structured that way. Maybe because in these REITs there's a lack of liquidity. And I'm totally guessing. Thanks for the call.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Well, golly gee willikers, everybody. Tom and I have learned something new today, thanks to our lovely listeners out there in Radio Land. Vanguard, on some of their funds, does charge a redemption fee. And they state that the reason for it is to reduce the number of transactions. It's to quote, these fees are designed to help those funds cover higher transaction costs and protect long-term investors by discouraging short-term speculative trading. So my guess in response to Chuck is, yes, you will pay the 1/4 point to get out. And here are the funds. This is something really interesting. You might need to be aware of this. And it's another interesting argument for ETFs.
Yeah, because you don't pay that with the exchange traded fund. You own the same group of securities, basically.
If you sell the Vanguard Emerging Markets Government Bond Index Fund, 0.75% is the
Emerging Markets Bonds.
Emerging Markets Bonds, 0.75% to get out.
That's pretty spendy. Yeah.
The Emerging Markets Government Institutional, same thing. Global ex-US Real Estate, same thing. Intermediate Corporate Index.
And how much you pay there?
1/4 point. Okay. International Dividend Appreciation, 1/4 point. International High Dividend Yield Index, 1/4 point. Now get this one. This surprises me. Long-Term Corporate Bond Index Fund. Both the Admiral and the institutional shares, 1%.
Is this something new? Because I've never heard of this until Chuck brought it up here. So,
long-term bond index, the regular long-term. Oh, yeah, the regular long-term bond index, not the corporate, the one that's both, 1/2 point. Wow. So those funds, that's the list.
Can we still call them no-load funds?
No, you can't.
Because it does have a commission attached to them.
That is a rear-end load. They are not no-load funds. I would get ETFs for everyone.
Yeah, no, I mean, you could own, as I said, for each one of those asset classes, I believe you could own a similar exchange-traded fund, which is probably cheaper, which is more tax-efficient, and does not include that, well, for lack of a better expression, commission.
Wacky. Didn't know it. I love learning new things, though. I will not forget that. 855-935-TALK is our phone number. We have a line open for you right now. 855-935-8255. And also, I need you to remember that we do podcasts. We do a podcast pretty much every day. We do some best ofs from way back when over the weekend.
Oh, we got a great one for next Wednesday, too. Wow.
We do have a good one for next Wednesday. Yeah. But we do some fresh shows, and we also take your questions at 855-935-TALK, 855-935-8255. But you can also send them in at talkingrealmoney.com, and a lot of you really love typing your questions. Now, if Tom and I had our druthers, we would ask you not to type them in and just speak them because it's more fun. But people send them in, and I have a ton, Tom. So we really have to get one or two.
We got time for one right now. Go ahead.
All right, here you go. I recently heard your podcast that REITs should not be owned in a Roth. Can you explain a little more why this shouldn't be done and what impact this has on your investments? Thanks again. Love your show.
REITs should not. I would say it the other way around. I think I just did a couple minutes ago that REITs, need to be owned in a qualified account, be they a regular IRA or Roth IRA or 401k, because of the treatment of the securities in there. 90% of those earnings have to be paid out as you got to pay tax on them. So you don't want to hold them in a regular brokerage account. I may have said it makes more sense to own things that grow faster.
Yeah. It's easy to be. That is not what we have said.
Intended.
It's not really what we said.
I think in a Roth you should have, emerging markets. I think you should have U.S. small value, the things that could grow more quickly than REITs or have historically.
All right, here's one that I think we can do pretty quickly on dollar cost averaging. Hi, guys, enjoy the show. I must be missing something. The analogy against dollar cost averaging going in is that the market generally goes up, so you'll likely miss out. Your caller asked about periodic withdrawals, and you advised against this. Why doesn't this make more sense? It will take. I hear music now. We're going to do this on the other side, Tom. You want to do it on the other side? Yep. He's wandered off already. He lost interest. We'll continue this question momentarily on Talking Real Money.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
47 in Seattle.
Reality radio for a really great future. We're talking real money.
We take questions from everywhere and from anybody, anywhere, anytime, 24 hours a day, 7 days a week. But the coolest thing is if you call on Saturdays between noon and 2 Pacific, 3 to 5 Eastern, you can talk to us live at 855.
Is that right now?
935-TALK. Are you actually physically here right now?
Barely. But yes, 855-935-TALK. Call us right now. Happy to answer any question.
You remembered the number only because I just
wrote
said
it down.
Okay.
No, I wrote it down.
All right, good job. And people also send them in at TalkingRealMoney.com, like the question we were getting to before the break, which I'm going to read again because nobody remembered, or you just tuned in and you went, I don't know what the question is. Here's the question. Hi, guys. Enjoy your show. I must be missing something. The analogy against dollar cost averaging going into the market is that the market generally goes up, so you will likely miss out. A recent caller asked about periodic withdrawals, and you advised against this. Why doesn't it make more sense to keep what he doesn't immediately need invested with this same theory?
No, let's step back first and talk about what dollar cost averaging is first.
Mm-hmm. We can do that.
Dollar cost averaging is the practice of having a lump sum of money and slowly putting it in the market. Or if you're putting money in a 401k, you're dollar cost averaging, right? You're buying every 2 weeks, different number of shares, different prices, et cetera. And the idea here is the reason that we don't really like that as a practice, if you do have a lump sum of money, is, as the writer correctly points out, the market has an upward bias. So it's better to be invested at whatever your stock to bond ratio is all the time, including new money, than to sort of say, well, I'll put in a quarter now, I'll put another quarter in 6 months, et cetera. That practice doesn't work as well in terms of making you money. However, I think that's important.
Here's the big difference, and we try not to make these rules. These are not absolute rules. Every rule is made to be modified or twisted or fit to your particular circumstances. But the biggest reason is for planning purposes. There is a difference between the accumulation phase of your investment life, which is when you're putting money in. You want as much in and you want as much bang for the buck as early as you can get it. When you are in the withdrawal phase, it's often, for most, it's a different matter. Because when you're in the withdrawal phase, we're big believers in a flexible withdrawal method where you take out a percentage of your portfolio every year, good markets and bad. And some years you take out a lot, and other years you take out less. We're big believers in that. But the problem with that is to do that effectively, you really need to take it all out at once, at the beginning of the year, whenever it might be, so that now, because we need a plan. You can't, when you're older, it's harder to wing it. You need to know how much money you have to spend over the next 12 months. Now, could you take it out every month? Absolutely. Might it make you more money? Yeah, it might. Probably will. But is it enough to take away that certainty of having that planning. And that's where I think the differences lie.
Most people do it every year or every 6 months.
Right.
They take money out, they rebalance the account, the cash goes into your account to spend, as you correctly say. Life goes on. So
it gives you the opportunity to plan. That's really the big difference. 855-935-TALK. Give us a call, and let's quickly head over to the phones. And Stephen. I'm sorry. Stephen, I missed Stephen.
Pat.
Oh, it's Pat?
Stephen. Pardon me. No, it is Stephen.
It is Stephen.
Yep.
Stephen, welcome to Talking Real Money.
We'll get this right.
Hey, guys. How are you?
Good, Stephen. What's up?
Hey, guys. How are you?
Good, thank you.
Hey, I've got a question. So my wife and I inherited $180,000 from the death of a relative, and we have $170,000 left on our mortgage for our home. So my question to you guys is, we don't have a lot in investments today. We've fully maxed out on our IRAs and our 401k contributions over the years. Would it be prudent to pay off the mortgage? We have a 3.25% rate on our mortgage, or does it make more sense to put that money to work in the market, given that we're both about 20 years out from retirement?
20 years out from retirement, 3.25%.
We're both 45. Yep.
And under the current circumstance, how long until that mortgage would be paid if you just paid it as you're paying it? How many more years
another
left?
Another 12 years.
Yeah. I would take the money. I would invest it. Yeah, I would not pay down the mortgage. No. Mm-hmm. I mean, again, and you kind of answered the question for yourself, because paying it off at 3.25%, we would hope you'd make at least twice that investing, or maybe even more.
Yeah, I think Tom is absolutely right. This is a no-brainer. You don't know what you're going to make, but you have the time to ride the markets.
Tom and Don are talking real money.
At some point, most investors need professional financial guidance. So get a little bit of free help or a lifetime of affordable 100% fiduciary guidance at vestory.com, vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
We know that money can be confusing and frustrating and just almost sometimes infuriating just dealing with it, because there's so much conflicting information and misinformation, and we're just going to hang out here and try to do it right. Try to help you figure this out better. So call us at 855-935-TALK. I'm Don McDonald, over there in the infamous aircraft hangar, Tom Cock.
Hello.
Yeah, the air museum in the Maltby Air Museum.
Oh, by the way, before we go to this next call, I want to shout out to Sherry, who lives just down the road from here, because she came in the office yesterday. There's a woman who should have her own talk show. She is funny. She's informative.
Does Sherry know that you're a neighbor?
Yeah, she knew. She all about the show and the Maltby thing and the whole.
Does she know where your house is? Is she like a stalker and all?
No, I doubt that.
It'd
be the other way around, if anything. But no, I mean, she's
you a stalker. Yeah, no chance.
She's. I just want to say hi, because she listens to every hour of the show each Saturday, or so she said. So
did you ever?
Thank you, Sherry.
Did you ever tell her there was an aircraft museum in Maltby just down the road?
I didn't mention that, but I'm betting you the next time I talk to her, she will bring that up.
Oh, hey, can I see the aircraft museum?
Yeah. You said this before, and there was a guy who once wanted to have a meeting in the hangar.
He did?
He wrote me. He said, I was like,
now,
okay.
Actually, now that
12 feet by like 10 feet.
Now that we've done that, you should probably take one of the corner conference room, the deepest, darkest conference room.
Oh, I see. And put a few planes up in there.
You're running out of room, dude.
I know. I have 36. I'm running. Yeah, it's a bit of a problem.
Yeah, you got to start a new. It's like they've got
new wing,
a new air wing. 855-935-TALK. That's our phone number. And Pat's up next. Pat, welcome to Talking Real Money.
Hello, gentlemen. Thank you for the education that I get by listening to you guys every Saturday. I tell everybody to listen.
Oh, you're good. Thank you.
Thank you.
I have two quick questions. I'm going to look for a tax preparer this year because my husband's in long-term care, and I want to make sure that I am getting someone who is able to tell me all the deductions that I need to be taking. And I'm wondering who should I call the financial advisor and ask them for a recommendation on a tax preparer?
Absolutely. Yep. They
Okay.
should have a list of people they have vetted that they know, they trust, and that they charge fairly. Absolutely.
Yeah. Every good financial advisor, particularly any good fiduciary advisor, is going to have that. So.
Excellent. My other quick question is the cost of the financial advisor tax deductible? Do you guys know?
Not anymore.
Used to
it
be.
was in the olden days. Yeah, they got rid of that one, Pat. So now
yeah, that's the
pay us
like
and
the cost
get over
of doing
it. So.
business. Okay.
Yeah, I know. Yeah.
All right.
Yeah,
Okay.
like all other tax policy, it was there one day and it was gone the next. So that's just the way it goes.
Can't count on anything.
Thank you guys
anymore,
so much. Thank you for.
Thank you.
Thank you. That reminds you, the state of Washington used to, what was it? All the money we had invested internationally for people, the fees that we collected on that part, that was deductible for a period of time.
That's just
weird.
wacky.
That's all gone too. Yeah, that's all gone now too. I forget what anyway. So yes, tax policy does change. So
all right, I'm gonna throw you another question from TalkingRealMoney.com because we've got time. Okay. Hey guys, do you have any rules or guidance for when to save versus invest? It's kind of interesting. I have a couple of goals I'm saving up for, but not sure if a savings account or brokerage is the better option. I currently own my car paid off, but I'll need a new one in about 5 years. Should I set aside money in a brokerage account or should I invest? I'd love to hear your guidelines or recommendations on saving for intermediate term goals. Great question. Thanks so much for the show and the sarcasm. He actually thanked us for our sarcasm.
Yeah. Yeah, not a lot of people thank me for that. So,
no, particularly not your family.
No, they do not appreciate it. So here's the thing. I think if it's 5 years and less, then I wouldn't be running out and putting anything in stocks. I would simply put it in either a short-term bond fund of some kind, high-yield savings, something like that, because you could wake up in those 5 years and find out the market's down and you needed the money.
Yeah, or the other thing you could do is if the goal is absolutely, then put it in a 5-year CD or something. And let's see.
True.
Whoa, we got time. We've got
well, we have another call here.
Yeah, so we have time. Nina, welcome to Talking Real Money.
Hi.
Hi,
can you
Nina.
hear me okay?
Absolutely.
So my question is, I'm wondering if I qualify for a Roth IRA. I don't have one yet. And it's a two-part question. The first part is I have a disability retirement, and I work part-time. So my first part of the question is the income, my disability income, does that count toward my overall income and whether or not I qualify?
Well, first, okay, if you have earned income, let me just take that part first. If you have earned income from a job that's on a W-2, you can, or a 1099 even, you qualify for a Roth as long as you're under the 129.
180?
Well, for a single, it's 129, and then it starts dropping off up to 180.
So if you make more than $130,000, you cannot directly put money into a Roth IRA.
It reduces, but
yeah.
But if you make less than 129 and you have disability income, you could do it from your other.
She was wondering if that could. Go ahead.
Well, I'm married, so my husband's income counts for we married or we were filed together. We're married.
How much do you make jointly? How much do you make jointly?
Well, we're very close to the limit of the. I think it's the marriage
208.
limit is 208. So
208, maybe 204. I think we looked this up before.
204. It's 204.
Yeah. So we're close to that limit, but does my disability income is not taxed. It was injury on the job.
Then it wouldn't count because it's your AGI or is it MAGI or just AGI? But it's your adjusted gross that counts for those income limits. So that income doesn't even go on your 1040, correct?
Correct. Right. So I'm nowhere close at that point. Okay, so that's part one. Part two is I work part-time, but I make very little money. because I'm not able to do a lot. But I'm wondering, I know you can only invest or you can only put into your IRA, your Roth IRA, no more than what you've earned. So
Correct.
no,
that's not true if you're married.
Oh, not if you're married. Yeah, if you're single. No, yeah. Sorry.
If you're single, yes, but if you're married, you could put the $6,000 or $7,000 away. Yeah.
Yeah. Oh, okay. Because I qualify for 7. I'm old enough, but I'm. Yeah. Sometimes, right. Last year I made just over 7. But moving forward, I just want to make sure I don't get myself in a pickle. I see what
doesn't sound like
okay.
it. No, because it would be you'd have that spousal ability. Because even if you had no income, because your husband has income, you could do $7,000 for you anyway.
I did not know that. Well, thank you.
You're good. You're very welcome. Thanks for calling. Thanks for listening. Tell everybody about it. Listen to the podcast on your favorite podcast service. And call us once in a while, all of you, at 855-935-TALK, 855-935-8255. Call anytime, 24/7, and leave your question. We'll answer those on the podcast.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
And by the way, it's modified adjusted gross income, MAGI, and the max for a married couple is $214 in tax year 2022. If you need some help with money and you want to sit down and talk with a qualified 100% fiduciary advisor, and you're saying, I don't really need somebody to do it all the time. I just kind of need some help figuring out this messy portfolio I had from my broker. I'm going to do it on my own, but I just need a little help. We'll do that for you. Our advisors will do that. We've done that for years. We'll continue to do that. And we do it with no obligation, at no cost, for a while. We will not manage your money for the rest of your life for free. That's dumb. But we will help you because we like helping people. And you can just set up an appointment to have that done. No sales pitch or anything. Just go to Vestory.com. That's Vestory.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. To keep the lawyers happy.